back to Prime Wealth. We're so glad you're here with us today.
Absolutely, it's great to have you join us. Today, we're diving into something that affects so many of us as we approach retirement age. Required minimum distributions, or RMDs.
Yeah, RMDs can feel a bit daunting, right? I mean, they're those mandatory withdrawals from your retirement accounts once you hit a certain age. But don't worry, we're here to break it down and make it manageable.
Exactly. We'll cover what RMDs are, when you need to start taking them, and how to calculate the amounts. Plus, we'll talk about some strategies to minimize the tax impact on your withdrawals.
And, for many people, understanding RMDs is crucial for planning their financial future. It's not just about the numbers. It's about making sure your retirement savings work for you, not against you.
Right, and we'll also touch on some common pitfalls to avoid so you can make informed decisions and feel confident as you navigate this part of your financial journey.
So stick with us as we unfold this topic, because understanding RMDs can really empower you to take control of your retirement finances.
Let's get started with the basics. What exactly are required minimum distributions?
So Alex, let's dive into why required minimum distributions, or RMDs, are such a big deal for anyone over 40, especially with all the changes happening in the economy today.
Absolutely, Jordan. For many people, they don't really think about RMDs until they're closer to retirement age, but understanding them now can make a huge difference in your long-term planning.
Right. It's like a wake-up call, isn't it? When you hit that magic age of 72, the IRS requires you to start withdrawing money from your retirement accounts. And that can really shake things up financially.
Exactly, and for a lot of folks, those withdrawals can mean a significant tax bill. The more you withdraw, the more you might end up paying in taxes, which can eat into your retirement savings. So planning ahead becomes crucial.
And with inflation being what it is right now, it's not just about meeting those RMD thresholds. It's also about ensuring that your money lasts throughout your retirement. I mean, we've seen costs rise for everything from groceries to healthcare.
That's a great point. With inflation, the purchasing power of your retirement funds can diminish over time. So if you're not careful with your withdrawals, you could find yourself in a tight spot later.
Yeah, I remember talking to a listener recently who mentioned how their retirement savings felt like they were dwindling faster than expected. They had planned for a comfortable lifestyle, but rising costs were really challenging that vision.
That's a common concern. Many people over 40 are starting to realize that the traditional retirement plan might not cut it anymore, especially with the unpredictability of today's economy. It's about being proactive, not reactive.
And it seems like many folks underestimate how much they'll need in those early retirement years. It's often the time when people want to travel, enjoy life, or even help their kids with big expenses.
You're so right. I've seen clients who planned on living modestly, but then realized they didn't account for the experiences they wanted to share with their family. Those RMDs can limit that flexibility if they're not managed well.
And that's where the emotional side of financial security comes in too, right? It's not just about numbers, it's about peace of mind. Knowing you can afford those experiences can really enhance your quality of life.
Exactly. Financial stress can take a toll on your health and relationships. When people feel secure in their finances, it often translates into a more relaxed retirement, which is what we all want, isn't it?
For sure. And I think a lot of people over 40 are starting to realize they need to take control of their financial future now rather than waiting. I mean, the earlier you start planning for RMDs, the better prepared you'll be when that time comes.
Definitely. And let's not forget about the potential changes in legislation that could affect RMD rules. It's not static. Staying informed can help you adjust your strategy accordingly.
Good point. With everything changing so rapidly, it's essential to stay on top of these issues. Plus, it can feel overwhelming to think about all these rules and regulations, especially if you've been focused on other priorities.
Yeah, and that's why it's important to have a plan. A lot of people don't realize that you can strategize your withdrawals in a way that minimizes the tax impact and maximizes your retirement income.
Exactly. And it can also allow you to have a more predictable income stream, which is super important for budgeting and retirement. You don't want to be caught off guard by how much you need to withdraw.
Right. And, it's not just about the money itself. It's about the lifestyle you want. How do you envision your retirement? Are you planning to travel, downsize? That all ties back into how you handle your distributions.
It does. I think a lot of people have a hard time picturing their future self, especially when they're still in the thick of their careers. But taking these steps now can really set the stage for that ideal retirement.
And let's not forget about the role of investments. If your portfolio is not aligned with your retirement goals, you could find yourself in a difficult position when the time comes for those RMDs.
That's a critical point. Sometimes people think they can just ride the market and not worry about it until they're closer to retirement. But the earlier you start adjusting your investments based on your future needs, the better.
Exactly. Making sure your asset allocation reflects your risk tolerance and your income needs can really help smooth out the bumps when those mandatory withdrawals hit.
And, we've talked about how RMDs can affect your tax situation, but they also impact your Social Security benefits. If your RMDs push you into a higher tax bracket, it could reduce your net Social Security income.
That's a great observation. It's all interconnected. Understanding how these pieces fit together helps you make smarter decisions. And it's not just about surviving retirement. It's about thriving in it.
So true. And it's also about legacy planning. Many people want to pass on wealth to their children or charity. Understanding RMDs can help you strategize how to do that without unnecessary penalties or tax burdens.
Absolutely. There's so much more to consider when it comes to RMDs than just the minimum amount you need to take out. It's about how it fits into your whole financial picture.
So, with all of these pieces in mind, what are some core strategies listeners can start thinking about today to manage their RMDs effectively?
Well, let's get into some actionable steps. So let's dive into some core strategies and rules of thumb when it comes to managing your required minimum distributions, or RMDs. This is really important stuff if you want to avoid penalties and make the most of your retirement funds.
Absolutely. One of the first strategies is understanding when you need to start taking those distributions. So for most people, the IRS requires you to start taking RMDs at age 72. But if you turned 70 and a half before January 1st, 2020, you might already be in that boat.
Right, and that can be confusing. You need to know the specifics of your situation. If you're still working and you have a 401k with your employer, you might not have to take an RMD from that account until you retire. Just remember, it's the traditional IRAs that really kick in at 72.
Yeah, and I think a good rule of thumb is to keep track of your accounts. It's easy to lose sight of things when you have multiple retirement accounts.
Exactly. A great way to manage this is to consolidate your accounts if it makes sense for you. Having fewer accounts can simplify tracking your RMDs and help you manage your withdrawals more effectively.
That makes sense. And when you look at your accounts, it's also a good idea to calculate how much you'll need to withdraw. The IRS has a specific formula for that, right?
Yes. The RMD is calculated by taking the balance of your retirement account at the end of the previous year and dividing it by a life expectancy factor, which you can find in IRS tables. So, for example, if you have $100,000 in your IRA and your life expectancy factor is 25.6, you'd divide that to find your RMD.
So that would be about $3,906 for the year, right?
Exactly. And that's what you'd need to withdraw to meet your requirements. But here's a crucial point. It's not just about meeting the minimum. You need to think about your overall financial picture and tax implications, too.
Right, because if you withdraw too little, you face hefty penalties. But if you withdraw too much, you might bump yourself into a higher tax bracket. So a balancing act, really.
Definitely. And that's where planning comes in. I often recommend working with a financial advisor to create a withdrawal strategy that not only meets your RMDs, but also aligns with your broader financial goals.
Speaking of strategies, can you share some common approaches for withdrawing funds? Like, should people take RMDs from specific accounts first?
Great question. A common strategy is to withdraw from taxable accounts first, if you have them. This way you can let your tax-deferred accounts grow for a bit longer. Then, as you start hitting those RMD thresholds, you can begin withdrawing from your IRAs or 401ks.
So it's about being strategic with your money and not just taking the minimum.
Right. And another important point is timing. You have until December 31st of each year to take your RMD. But if it's your first one, you can actually wait until April 1st of the following year.
That's good to know. But isn't there a catch with that first RMD?
Yes. If you do delay your first RMD until April 1st, you'll have to take 2 distributions in that year. So that could push you into a higher tax bracket, depending on how much you're withdrawing.
Wow, that's a lot to think about. So what's the best way to keep track of all this?
Using a spreadsheet can be really helpful. You can list out your accounts, their balances, and calculate your RMDs. Or, if that's not your thing, there are also financial apps that can do this for you.
Oh, I love the idea of using an app. It makes everything so much more accessible.
Absolutely. Plus, some of these tools can send you reminders when it's time to take your distributions.
Super helpful. Now, what about tax implications? You mentioned earlier that RMDs can impact your tax situation.
Yes, and it's essential to consider how your RMDs affect your overall income. Remember that RMDs are taxed as ordinary income, so if you're not careful, you could end up paying more in taxes than you anticipated.
So we're back to that balancing act again, right?
Exactly. It's about being strategic not just with your withdrawals, but also with your overall income sources. For example, if you have taxable investments, you might want to consider harvesting gains or losses alongside your RMDs.
That's a smart approach. But what if someone doesn't need the RMD for living expenses?
Great question. If you don't need the funds, you can always consider reinvesting them. That said, you still have to take the distribution, so you could contribute it to a Roth IRA if you're eligible, or consider donating it to charity.
Charitable contributions are a nice way to give back while also managing tax liabilities.
Exactly. Plus, if you're over 70 and a half, you can do a qualified charitable distribution, or QCD, which allows you to direct your RMD to a charity without it counting as taxable income.
Wow, that's a win-win.
It really is. Just make sure to keep good records of any QCDs, as they need to be reported properly when you file your taxes.
So it sounds like there are a lot of moving parts when it comes to RMDs.
Yes, and that leads us into some common pitfalls people face. Many people overlook the importance of planning ahead and understanding their tax implications. It can really catch them off guard.
I can see how that happens. What are some other pitfalls?
Well, another common mistake is not taking the RMDs at all, which can lead to severe penalties.
That's definitely something you want to avoid. Let's explore these pitfalls more. So, Alex, let's dive into some of the common pitfalls people run into with RMDs. I mean, it sounds straightforward, but life has a way of complicating things, right?
Absolutely, Jordan. One of the biggest mistakes I see is people simply forgetting about RMDs altogether. They think, oh, I don't need to worry about that yet. And then, boom, time flies, and they miss their distribution deadline.
Right. And that can lead to some hefty penalties, can it?
Exactly. If you don't take the required distribution, the IRS can impose a penalty of 50% on the amount you were supposed to withdraw. So for instance, if your RMD was $10,000 and you forgot to take it, you could end up owing $5,000 in penalties alone.
Wow, that's a serious hit. It's like a double whammy. You miss out on the money you should have taken, and then you're slapped with a penalty.
Yeah, it's tough. Another common issue is underestimating your RMD amount. Some folks think, oh, I'll just take a small distribution. And they don't realize that it's based on their life expectancy and account balance.
So they might end up taking too little, right?
Exactly. And when you take less than required, you're still looking at that 50% penalty. I had a client once who miscalculated his RMD because he didn't factor in all his accounts. He only calculated based on one IRA, and that really came back to bite him.
That's a great point. People often have multiple retirement accounts, and it's easy to lose track of what's required from each one.
Definitely. It's crucial to aggregate the balances across all your retirement accounts. Just because you have multiple IRAs doesn't mean you can skip on your RMD.
What about those who try and get creative with their distributions, like thinking they can just transfer funds instead of actually withdrawing?
Yes. That's a dangerous game. Some people think, I'll just move money from one account to another, and that'll count. But the IRS isn't going to let you off the hook that easily. You have to take the distribution as cash or equivalent, not just shuffle money around.
I can see how that could lead to problems. And it's not just about avoiding penalties. It's about ensuring you have enough liquidity too, right?
Exactly. You want to make sure you have access to that cash when the time comes. Another pitfall is not considering the tax implications of your RMDs. You're not just taking money out, you're also creating taxable income.
Right. So if someone isn't careful, they could end up in a higher tax bracket just because they didn't plan for their RMDs properly.
Yes, and that's where planning ahead really pays off. For example, if someone has a large RMD and they're still working, that could push them into a higher tax bracket, increasing their overall tax burden.
Wow, that could really impact their financial picture. Have you seen any real-life examples of this?
Sure, I had a client who was nearing retirement and still working part-time. They had a significant RMD due, and they hadn't factored in how it would affect their total income for the year. When tax season rolled around, they were shocked at their tax bill.
That's tough. So planning isn't just about the withdrawal amount, but also about timing and overall income strategy.
Exactly. And speaking of timing, another common mistake is waiting until the last minute to take the distribution. People think they can just wait, but the IRS sets specific deadlines, and it's best to avoid that scramble.
It's almost like a ticking clock, right?
Yeah, and that sense of urgency can lead to rushed decisions, which often isn't ideal for financial planning. Instead of making informed choices, you might just take the first option that comes to mind.
And that could lead to decisions that don't align with their long-term goals.
Yes, and it's also important to remember that your RMDs can affect your Social Security and Medicare premiums too. If your income spikes due to a large RMD, it could have unintended consequences on those benefits.
Wow, it really is a domino effect.
It truly is, and then there's the emotional side of things. Some people are reluctant to withdraw money from their retirement accounts because they're worried about running out of money later. They might think, if I take this RMD, what if I need it later?
That's such a valid concern. It's tough to balance enjoying your retirement with the fear of depleting savings too quickly.
Exactly. It's a tricky balance, and that's where working with a financial advisor can really help. They can assist in creating a strategy that addresses both your RMDs and your long-term financial goals.
So what are some signs that someone might be heading into dangerous territory with their RMDs?
Well, if you're constantly stressed about taking your RMD or unsure about the amounts, that's a red flag. Or if you find yourself making last-minute decisions, that's another warning sign. Also, if your tax situation feels unpredictable as a result of your withdrawals, it's time to reevaluate your approach.
Those are excellent indicators. It sounds like being proactive rather than reactive is key here.
Definitely. So if you find yourself in any of these situations, it's a good time to step back, assess your strategy, and consider reaching out for help.
That leads perfectly into what we can discuss next. Some immediate steps listeners can take to get back on track with their RMDs. So Alex, now that we've unpacked RMDs, what do people actually do about them? I mean, it can be overwhelming to think about taking these distributions, especially if someone's just starting to learn about them.
Absolutely, Jordan. It can feel like a lot to digest. But the good news is, there are some practical steps people can take right away to get comfortable with RMDs and their implications.
Okay, let's break it down. What's the first thing someone should do if they're nearing that age where RMDs kick in?
Well, the first step is to know when your RMD starts. Generally, it kicks in when you turn 72, but if you turn 70 and a half before January 1st, 2020, you're still under that rule. So check your age and find out if you're approaching that milestone.
Right. So knowing your age is crucial. What's next?
Next, gather your account information. You need to know where your retirement accounts are held, like IRAs, 401ks, and any other tax-deferred accounts. Understanding what accounts you have will help you calculate your RMD.
And what about the actual calculation? That sounds daunting.
It can be, but there are tools available. The IRS provides a life expectancy table you can use to calculate your RMD. There are also plenty of online calculators that can simplify this process. Just input your account balance and age, and it'll do the math for you.
That sounds manageable. But what if someone feels uneasy about doing this on their own?
That's a good point. If you're feeling unsure, it might be wise to consult a financial advisor. They can help you navigate the rules and make sure you're compliant while optimizing your withdrawals.
Love that idea. It's like having a coach in your corner. What about tracking your withdrawals once you start taking them?
Excellent question. Setting up a spreadsheet or using budgeting apps can be really helpful. You can track your RMDs along with your other expenses to see how they fit into your overall financial picture.
So, a simple tool can keep you organized. What about habits? Any daily or weekly practices to incorporate?
Sure. Start by dedicating a little time each month to review your retirement accounts. This could be a simple check-in to see how your investments are doing and remind yourself of your RMD obligations.
And what about reading material? Anything you'd recommend for someone wanting to dive deeper?
Definitely. There are great books out there like The Boglehead's Guide to Retirement Planning. It covers a lot of ground on retirement strategies, including RMDs. Also, consider following financial blogs or podcasts that focus on retirement planning.
That's a great way to stay informed. So we've talked about knowing your age, gathering account info, calculating RMDs, and developing tracking habits. What else should listeners keep in mind?
A critical part of this is understanding the tax implications of your RMDs. It's important to know that these distributions are considered taxable income. So having a tax strategy in place is key.
That's definitely something to think about. Are there specific apps that can help with tax planning?
Yes. Apps like TurboTax or H&R Block can be very useful. They offer features that help you prepare for tax season and understand how your RMDs will affect your overall tax situation.
It's all about being proactive, right? Maybe even set reminders in your calendar to check in on your financial situation regularly.
Exactly. Building a habit of checking in on your finances, setting reminders for RMD deadlines, or even having a yearly financial review can make a huge difference.
I love that. It's like making finance part of your routine. It doesn't have to be a chore. It can be empowering.
Exactly. And let's not forget to consider the possibility of using your RMDs for charitable contributions if that interests you. There's a way to donate your RMD directly to a charity, which can also help with your tax situation.
Oh, that's a win-win. You're helping others while managing your tax burden.
Right, and if someone is still working and has a 401k, they might not need to take their RMD from that account right away, depending on their employment status. So you want to look at all your options.
So there's a lot to consider. But it sounds like with some planning and the right tools, it's really manageable.
Definitely. And remember, taking small steps is key. You don't need to tackle everything all at once, just start with one action item and build from there.
It feels a bit less overwhelming when you put it like that. So those actionable steps really set the stage for a smoother transition into managing RMDs.
Exactly. So those are some immediate steps you can take. Now, let's bring everything together. All right, so let's recap what we've covered about required minimum distributions, or RMDs.
Yeah, definitely. First off, one of the key points is understanding when you need to start taking those distributions, right? You've got to be aware of that age threshold, 72 years old.
Exactly. And then it's crucial to calculate how much you need to withdraw each year. It's not just a simple number. It depends on your account balance and life expectancy.
Right. And we also talked about the importance of planning for the tax implications, because those withdrawals can really impact your taxable income.
That's a big one. So the more you plan ahead, the better you can manage your tax obligations. It's all about strategy, after all.
And don't forget the flexibility with your withdrawals. You can always take more than the minimum if you want, or if you need to, but it's about finding that balance that works for you.
Absolutely. And remember, being proactive with your RMDs can help you maintain your financial security in retirement.
Well said, Alex. It's all about being prepared and making informed choices.
And that brings us to the end of our discussion on RMDs.
So, as you think about your own retirement planning, keep these takeaways in mind. Remember, you've got the tools to make smart financial decisions.
Yes, and if you found this episode helpful, we'd love for you to like, subscribe, and share your thoughts in the comments. And don't forget to share it with someone who's over 40 and might benefit from this information.
Next time, we'll be diving into the retirement bucket strategy, exploring the differences between short-term and long-term approaches.
That's going to be an exciting conversation.
We can't wait to see you then.
Take care, everyone.
Bye for now.